Hello and welcome to this week's episode of Nucleus Investment Insights. Today we're going to discuss the Australian property market and what the future likely holds. As many of you will be aware, the RBA just raised the official cash rate by 50 basis points a couple of days ago, which is the largest rise in over 2 decades. On the agenda, we're going to look at what the market's pricing in for future interest rate rises and the impacts that'll have on the Australian households and the wider economy. From this perspective, we're going to have a debate about the likelihood of a property crash, a soft landing, or for prices to be flat or for the boom to continue. My name's Sam Kerr. I'm the Senior Financial Advisor at Nucleus Wealth. Today, as always, I want to welcome the Founder and Chief Investment Officer at Nucleus Wealth, Damien Klassen.
Hi, Sam.
Hey, Damo. Also want to welcome one of our other most valued contributors, Leith van Onselen, Nucleus Wealth Chief Economist. Leith, thanks for joining us again. And finally, today we also have a special returning guest on the show, who's a buyer's advocate, media commentator and economist. I'd like to welcome Catherine Cashmore.
Hi, everyone.
Yeah, apologies. We had a few technical difficulties, and we've lost Catherine's video feed there, but we'll be able to hear her. So please, we do apologise, but it should be fine going forward. So just a quick reminder before we get started: if you enjoy our content, please subscribe to our YouTube channel and click the bell below to be notified when we go live or have a new episode recorded. Alternatively, you can follow us on your preferred podcast platform. Our show's available on all the majors. So this is a pretty hot topic. So for those of you listening live, feel free to drop your questions in the YouTube live stream chat, and we'll do our best to answer them during the show. So now we've got that bit of housekeeping out of the way, we'll get started. So Damien, I'll hand it over to you to lead us away.
Yeah, sure. So I thought I'd just frame some of the affordability stats. So we've got a property report coming out later on today, just to update for all the latest. We've got some of the charts we're just going to throw up now, just on I put the Sydney and Melbourne housing affordability up there, just to sort of show the effect of the rate rise. So we keep 3 different ones as our sort of core measures of this, largely from an owner-occupier point of view, in terms of saying, look, what's the difference between a mortgage payment and the median wage in the state that it's in, so you can sort of see how it's moving over a long time, the mortgage payment relative to the rent, and then the mortgage payment relative to the median wage. Now, I've only just run the numbers, but I've got to change my chart axis now to add in more, because the mortgage payments to rents in Sydney are now well over 200%. They're both at sort of, and mortgage payment to median wage is at sort of 85%, which is both at the highest levels they've ever been. Melbourne is a bit lower, but still at its 96% off for both of those. And then if you look at the property price to median wage for both cities, so that's less of an important measure on those. It's the property price to median wage is more about, can you afford the deposit, whereas the above 2 are more about, can you afford the ongoing payments, which we treat as being more important in terms of affordability measures. And both Sydney and Melbourne are both at the 99th percentile. If you look through other states, it's cheaper in Perth, it's cheaper in Adelaide, but sort of more on the slightly above average. And then if you look at the unit side, it's still, some of them are still a little bit cheap actually on the unit when you look at these same affordability measures. So yes, to most of the actions in houses and units are still not that bad in terms of, they're not cheap anymore, but on these affordability measures, but they're not as terrible as they're sort of not at all-time highs like you're seeing in terms of the housing. Anyway, I'll leave it at that and jump into you, Leith, to talk through some of the sort of a quick background, I guess, on some of the other interest rate forecasts and sort of your thoughts, and then we'll let Catherine add it in terms of her thoughts on property markets.
Yeah, so the whole debate around the Australian property market, house prices, whether or not it's going to crash, whatever, is it really gets down to how aggressively the Reserve Bank of Australia hikes interest rates. Now, if you go by the actual projections, the story is pretty somber. The futures market is tipping that the official cash rate is going to be 3.1% by December this year, and 3.9% by May next year. So that's in 11 months, and that's up from obviously the current level of 0.85%, which went up 0.5%. The economists are a little bit less hawkish. They're tipping a cash rate of around 2.75% next year, the median economist. But again, that's an increase of about 1.9% from where we are currently. Now, what this means is that the discount variable mortgage rate, which is currently, which at the start of this month was 3.7%, is going to rise under the economist's forecast to 6.1%.
Yeah, so I mean, it's 4.2, I guess, after everyone's passed it on.
Yeah, that's right. That's right. But
yeah,
I'm just, yeah. So 4.2% after Tuesday's rate hike. Yep. It's going to rise to about 6.1%. If assuming the cash rate rise is passed on in full to mortgage borrowers. But under the futures markets forecast, we're going to have a mortgage discount variable mortgage rate by May next year of 7.25%. Now, I've run the numbers on this, which is based on mortgage repayments on the median price dwelling with a 20% deposit principal interest loan based at the start of this month, which is obviously before the 0.5% rate rise because I was using RBA data. And what this shows is that under the economist's forecast, the monthly mortgage repayment on the median priced home across Australia is going to rise by $877. So that's $877 extra a month under the economist's forecast. And under the futures markets forecast, the monthly mortgage repayment on the median priced Australian home is going to go up by over $1,300 a month. Now, that's an increase under the economist's forecast of a third, roughly, of mortgage repayments. And under the futures markets forecast is nearly half. So effectively, under both scenarios, Australian mortgage borrowers are going to face a massive, massive increase in mortgage repayments. And this will obviously have, big impact on not just home buyer demand, but it's going to have a huge impact on the economy because every dollar that goes into mortgage repayments is obviously money that's not spent elsewhere across the economy. And household consumption is the biggest driver of the economy. Household consumption alone, on average, accounts for 55% of final demand, which is the nation's economic growth, once you exclude net exports. So basically, where household consumption goes, the economy generally follows. So if we're going to have households spending, $800 to over $1,000 more per month in their mortgage repayments, it's going to obviously crush household consumption. It's going to crush growth. It's going to that would be made worse by the fact that house price falls also impact consumption. So if we get sharp house price falls as well, that's going to smash consumption even more. And my concern is obviously that soaring interest rates, soaring mortgage repayments are going to throw the whole entire economy into recession. Now, there's one other thing to point out before I finish up, is that never before have we started a rate hiking cycle with consumer sentiment in such poor condition. Now, according to the ANZ-Roy Morgan Consumer Confidence Index, which basically tracks perfectly the Westpac's version as well, consumer confidence is currently at its currently right now, before Tuesday's rate hike, was worse than it was at the very trough of the global financial crisis. So we're starting this rate hiking cycle with consumers incredibly depressed. And obviously, if mortgage repayments soar, it's going to smash household consumption even more, and which is going to obviously create more headwinds for the economy. So my view is that, we saw Australian house prices soar by 35% over the pandemic on the back of, massive cuts to mortgage rates. So obviously the flip side will happen if you do the opposite and you massively increase mortgage rates. You're going to have heavy house price falls. Basically interest rates are a double-edged sword there. And just looking at the actual, the potential quantity of price falls, the Reserve Bank's model that updated in its most recent financial stability report noted that if interest rates go up by 2%, real house prices will fall by 15%. So that's real house prices. So once you factor in inflation, that means roughly a 20% house price fall. That's the Reserve Bank's model. Now, given that the median economist is tipping that the cash rate's going to rise to about 2.75%, that implies a real house price fall of about 20%. And under the market's projection of a 3.8% cash rate, that implies a real house price fall of about 28%. So really, this whole debate about the housing market, house prices, etc., all depends on how fast and how sharply the Reserve Bank of Australia hikes interest rates. For this reason, because the impact would be so severe, I do not expect the Reserve Bank to lift as aggressively as either the economists or the markets are predicting, because I think they'll get stopped out beforehand. And
actually,
fact,
Leith, just a quick one.
Yep.
Leith, in terms of their model, what's the time frame on that?
Over 2 years.
Terms of over 2 years, right?
Yeah, 24 months.
So I guess what I'm saying is they could if they're going to hike quite aggressively, and property prices fall by that much, I guess they might not see it. I suppose. Yeah. I guess I'm sort of. I've got a lot of sympathy with you going, look, they're going to cause a massive recession if that's what they do. But the flip side is, well, they might not have actually. If the house prices are backloaded, they might not have actually seen the effect, and so they're happily just raising interest rates, going, oh well, house prices have only fallen a little bit, and just keep jacking rates, and then forgetting that it's going to come through later.
Oh, absolutely. And look, I think the only way we get to this kind of scenario is if there's a mistake. If they don't, if basically the RBA makes a mistake and they don't stop out too early, there is a more hopeful scenario, obviously, in that we're about 6 months behind places like New Zealand, etc., in a tightening cycle. So it could be that the rest of the world, or these other economies, hit the skids first, which then stops out the RBA early, which is kind of and then in that case we'll again be the lucky country. So I'm sort of hoping that could happen as well. But yeah, that's basically my top end view.
Okay, well let's get across to Catherine then before too long. Yeah, Catherine, over to you.
I'm not going to go against what Leith is saying regarding it. Really depends on how fast the lending rates rise for borrowers. But I think that's been the case in the run up to the peak of every cycle. So, I mean, if you look back at the run up to the peaks of previous cycles in 1973, 1989, 2008, rates always rose along with prices. And the market went with it. Prices continued to increase for various reasons, and each cycle had its own, unique things that were driving it. Obviously, the driver of every property cycle is speculation, so it's going to be affected by, buyer grants or what's going on in the general economy, policy, and so forth. But then there was a point where they did get too high, and it was the case that the debt had risen beyond the owner's ability to pay. And then you get the breaks in the economy that come through. So mortgage fraud is uncovered. You get a banking failure somewhere. You get, the weaknesses in the system are shown because so much speculation has gone into land speculation and not into the productive sectors of the economy. And everything seems to have been going well. Everyone's been enjoying the party, and no one has been realizing that, we've been eroding away the things that are going to hold up the economy. So at some point, it will get to that point. The question is, when will it get to that point? And I guess that's where I'm going to, differ, because if you're calling it for this year or next year or even the year after, then, obviously one of my jobs is to study, land cycles, which have a very solid history behind them, and actually give very good indication as to when this might happen that none of the economists study. So you can quote the economists from the CBA and the four banks, but honestly, they've been pretty consistently wrong over the last few years regarding where house prices will go and where rates will go. No one thought, well, first of all, CBA included, thought that there was going to be a humongous crash in 2020, in March 2020. By September, they'd completely flipped that, their 32% prognosis of prices falling to, prices are going to rise now. The same when it came to forecasting rate rises. It wasn't so long ago that they were saying that there's not going to be any hikes till 2023. And then, I think earlier this year, no hikes. And then, they were underestimating where it's going to go. So let's face it, there's a lot of blind flying out there where people are just looking out the window and seeing what the weather says and then just making a forecast as to, well, I think this is going to happen then. And they're ignoring the fact that we actually have a cycle here, which is giving us good indication of where these things are going to happen. So, I can give you reasons why I think that I agree with Leith in so much as I don't think that the RBA are going to, I think that what happened, the move that we saw a couple of days ago was a move to shock, right? The language came out, it was shocking. It was basically stop spending. Right? That was the language that came out, and people got nervous around it. And a lot of, homeowners that I know personally were talking to me and saying, oh, we're really nervous, not so much because they can't afford what's happening right now, but because they're hearing these prospects that, we're going to really hike your bills up over the, and you've got to be prepared for it kind of thing. And that just kind of put a shock in the system. But I'm not so sure that they're going to follow through and necessarily manipulate downturn at this point in the economy. And let's just one more point. Real interest rates are still far below zero. So we're not anywhere close to taming where inflation is. Not that I believe that rising interest rates is necessarily going to do that anyway when it's coming from the supply side.
So, interest rates, 18 months ago, you could pick up a three-year for 2% or below. Now we're looking at, the best you can get on a standard variable. Well, sorry, not the best. The average rate on a standard variable rate through, using the RBA stats is 4.2. So obviously the 2% was ultra low. We'd never been, or very rarely ever been anywhere near that level. And so this is, I guess, in a way, we've sort of had this normalization. In terms of the people, sort of the buyers that you're looking at, the buyers that are coming to you as a buyer's agent, has that amount of move made much of a difference already in terms of that sort of, 2 to, well, I suppose it's only really, it was only really 1.7% or whatever until this week, till Tuesday. But I guess, Catherine, what are your thoughts on how that actually affects existing people who you're talking to?
Yeah, well, you're not going to like. Well, not that you're not going to like what I'm saying, but I mean the thing is.
I haven't got a horse in this race. I know I'm certainly more on the case of Leith, but I'm interested in knowing if this is going to extend for another 18 months. And I guess I'm genuinely interested in what's happening on the ground, because you're right.
Yeah,
that's theoretical models.
Yeah, no, I understand. I was kind of misfired a little bit because I know you kind of not got it, but I guess it's the. So I've spoken to a few people lately. First of all, and these are genuine conversations that I've had with people that I work with commonly. So obviously, I'm in contact with mortgage brokers, and a mortgage broker I was talking to was telling me that he's back to being as busy as he was prior to everything. He's back to normal, is what he's saying to me. Everything's back to normal. He's really busy. So it hasn't kind of hit his demand. He's at the point where he's looking to hire more staff. I had a chat with somebody yesterday, and I think this is one of the things that people are, whenever you're talking about rising rates, you've got to be looking at what the other drivers are in the housing market right now. Outside of what the government's doing, we've got a rental crisis. We've got a ramp up in rents. And I was talking to a developer, a very big developer, yesterday, had a meeting with them, and he was very bullish about the future because he doesn't see that the building activity is going to increase to a degree where we can basically alleviate the rental crisis that's going on. So, that the income on the earnings of the land is increasing for a proportion of investors that have even in Melbourne, you've got, the vacancy rate is pushing down. So there's that driver to it as well. But the buyers, what they're doing is every buyer that I'm working with, and at the moment, and have been, for a while, have been very cautious about taking on too much debt. So they come to me, they'll let me know what they can borrow, but then they'll let me know what they want to borrow, right? So they always give me a lower budget than they can actually borrow. So people are being very cautious, regarding that. They're not overextending like we do see at some stages of the cycle. And the other thing that's driving the market is that, we're sitting in Melbourne, right, where prices have skyrocketed over the last couple of years. And I mean skyrocketed, because I've never seen a boom like what we've just been through since sort of the end of 2021 through 2021 and into 2022. But the rises was utterly spectacular. And so we're sitting here, everything's really expensive. Someone sitting in Sydney, everything's really expensive. But you're forgetting that now, investors they've got out of this mindset that they need to necessarily invest in the state that they live in. And they're eyeing up real estate in Perth and Adelaide and Hobart. It's a bigger story, I think, than we're seeing. And in those areas, the buyers that I'm dealing with in other states are buying into the market. And even where we are now, they're coming out in a positive situation. They're cash flow positive because of the rise in rates.
And sorry, are we talking? So we're talking mainly investors, is what you're looking at?
Investors, yeah, home buyers as well, in terms of what they want to stretch, where they want to stretch to. But investors have come back into the picture. We had a spate there where there were a lot of home buyers and people were running around and everyone was moving based on coming out of the COVID crisis and the panic that ensued around that time. But investors are back in because land is seen as a hedge against inflation of what's going on now. I mean, people are rushing into areas where they feel safe, and real estate is one of those areas. And when you're looking at a state like Perth, for example, which is in the throes of a commodity boom, that does have wage rises in that sector, that is opening the borders to immigration, that's looking incredibly cheap, has got low unemployment, is doing better in gas prices than anywhere else in Australia. Those are pulling people in. You've got rental rises going through the roof. They've got vacancy rates which are close to zero.
Yeah, well, definitely Perth is going to handle the rate rise a lot better than anyone else. It's so cheap. Hasn't it didn't have the increases over COVID. Brisbane, Adelaide, etc.
Energy prices in Perth are not likely to. Whereas if energy prices, wholesale energy prices, stay where they are in the eastern states, you're going to double your electricity bill, and whereas Perth doesn't have that problem. Yeah.
No, but yeah, even energy side and all cost of living and that sort of stuff. Perth didn't experience the boom that the rest of the nation experienced over the pandemic. So, and it was already cheap because it had fallen for 5 years. So Perth is going to be an outlier, I think, no doubt about it. But as always, the Australian property cycle is going to be driven by Sydney and Melbourne, which are, they're already falling. Both cities are already falling in value. Auction clearances have collapsed in both cities. It's looking pretty bad for those places. I think Brisbane and Adelaide will be later. Like, they're still rising, but starting to slow. I think the whole thing is going to be led by Sydney and Melbourne.
Sure. Now, Catherine, so you spoke a little bit there about saying you're still quite positive, I guess, in terms of the demand levels that you're seeing from people, and they haven't really been scared away yet by higher interest rates. Most of the property indexes have rolled over in the last few months, and so we have been seeing sort of falling prices at the property index levels. Is that something? So I guess how do you marry that up with your sort of relatively bullish view in terms of, or I guess the demand levels? So if demand's not falling away, how do you marry that with the price action we've sort of seen recently?
Yeah, well, I'd actually forecast that back in 2019, 2020, that Melbourne and Sydney would probably slow. Just in kind of the cycle and the charts we were doing at the time kind of indicated that. But against the growth that we've had over the last couple of years, that could not sustain. And that level of growth, if you look at charts that CoreLogic were putting out, and they were showing the pace the percentage growth, the pace of growth that had happened through 2020, 2021. And they were saying, it's not been this fast since 1989. Well, 1989 was a point where people had, pulled their money out of the stock market and were pouring it into the property market. It was a very bullish time in the cycle because we knew it was time just before a downturn, if you understand how the cycle is timed. And then the last time that we saw such incredible growth like that was in following the GFC, when Kevin Rudd pumped money into the system via his home buyers boost, and he allowed temporary visa holders to buy real estate and poured money into infrastructure spending, which of course all sinks into land values. And that, to me, the driver of what we saw over the last couple of years, more so. I mean, okay, you can say, the low rates obviously added to it, but I think the real push there were the stimulus payments that came out and the cash that was going into not everyone's bank account, certainly not mine, but into people's accounts. So over that period of time, all found its way into the land market, and could not.
But the argument is we're going the other way.
Now, though. Because we've got soaring energy costs and cost of living going through the roof, which is really unstimulus. Like, that's the opposite.
Exactly. So let's talk about what we're going to see now. 100% things have pulled back. It's a much easier market now in Melbourne in terms on the buyer side. And what I mean by that easier is that you've got more power when it comes to negotiation. And that's because there's more stock on the market. It means that buyers are less in the FOMO mindset that they were in. That whole kind of cycle is gone of where we were in that 2 years. And so, the median price is going to fall back. But when you're on the ground working in it, it will fall, but it falls back in some areas and not necessarily others. So, for example, Ballarat's still going pretty strong. And there's still areas in the regional centres where you have to move very quickly or you're going to miss out. Whereas there's other areas in inner city Melbourne which just aren't going quite as strong as they were. So it's probably the case that owners are going to sell. They're not going to get as much as they could have done, perhaps had they sold a few months ago. And that means that the median's going to come back. But it's part of what we see. It's part of what we see in pretty much every stage of, whenever we're in these kind of stages where you're seeing interest rates increase, the market kind of ebbs and flows along with it. I guess what I'm trying to say is that I don't see that it's on the precipice that we're about to crash because there's a softening in the market. I see that had to happen. That was inevitable, that you could not continue that pace of growth. And the same in New Zealand, which again is everything's looking bearish that's coming out of New Zealand. But of course, when you just focus in the moment on what the data's doing, and it depends, it looks like that, but it's not necessarily saying, right, the timing is now. We're on the verge of prices falling back 10, 15%.
Yeah, well,
is there a level, Catherine? Sorry, Leith. Just can I say quickly first, Catherine? Is there a level of interest rates where you would become bearish? Like, I mean, let's say let's say it wasn't 50 basis points yesterday. Let's say it was 5%. They raised interest rates. On Tuesday. Is that at what level do you go? Oh, okay. So I guess your argument is it seems to be that actually there's still enough demand. There's still enough people who can afford it. They'll help carry the market. And yes, interest rates have come from really, really low to sort of more like an average price now. So that's it. It's obviously it's not a tailwind, but it's not a massive headwind yet, I guess is what you're saying. At how high would they have to get before you'd go, okay, now I'm changing my mind? Another 5%, interest rate is too high, or is it 1% more, or is it 2% more? What's your sort of line in the sand? Or rough?
Yeah, I mean, I think it goes back to what I said before. I think it's really important to look at the interest rate adjusted for inflation, what real interest rates are. And real interest rates, I think when I last looked, they're down kind of minus 4% or coming close to it. So, I mean, if you're going to do a massive hike and suddenly push interest rates, from where we are now up 5%, which is the example you gave me there, 100%. I mean, we know anybody that look, when I talk about studying the land cycle exists because we allow speculation in land, we allow the banks to lend predominantly against land, all the policies that we have push towards that way. And so you get this boom and this bust in the way that the market cycle runs. But that doesn't mean that we have to have a market cycle. It doesn't mean that it's fated to happen. So, I mean, you can have a policy change that comes in and says, okay, we ramp up interest rates and we'll crash the market, or we'll suddenly tax land very heavily and make it completely impractical for anyone to invest in land. And then suddenly the buyer market goes away. And let's face it, your property is only worth what you can sell it for at any moment in the market.
Sure. Okay. So under my, I guess, just use my example. Yep. Okay. 9% mortgage rates. Yeah, it's all over. Where's, I guess, what I'm trying to gauge is, where's the line for you? Is it 7% mortgage rates? Is it, so we're at 4.2 at the moment, call it. Where do you start to get nervous? 5, 6, 7%? What's
Oh, for sure. I mean, if you were going to ramp it up to around 7% now, but of course it still comes back to what I said regarding inflation. I mean, are they rising interest rates enough to combat the inflation that we're seeing? I mean, I think that's the point.
I don't think it matters, because I get what you're getting at, but the difference we've got, so it sounds like you're hearkening back to like the 1970s example, where we had like high inflation, stagflation, blah, blah, blah. The difference is we don't have automatic wage adjustment here like we had in the 1970s. So just because you got high inflation doesn't matter if wages don't match that inflation. And
that's where I was at the moment as well.
Yeah, exactly. So at the moment, we've got a massive power imbalance between businesses and workers, capital and labour, and real wages are going backwards fast at a rate of knots. And the March quarter national accounts that came out last week showed that basically unit labour costs, which is basically wage costs to businesses adjusted for productivity, almost at their lowest level in history. They've fallen for 35 years straight. They peaked in the 1970s, which is the sort of period I think you're alluding to. So what this means is, just because you've got high inflation and real interest rates are low, real interest rates are negative, doesn't matter when real wages are negative, which is what they are. And there's no mechanism to automatically adjust wages upwards to match the inflation. Like all the old systems that we had 30 years ago, 40 years ago are gone. So basically, you've got workers' wages going backwards at the same time as their mortgage repayments are about to double. And that, to me, spells, if the RBA follows through with the market's forecast or even the economist's forecast, which I don't think they will, to me that spells economic doom and a house price crash. But of course, it all depends on whether or not the RBA does what they're forecasting. That's what the whole crux of this argument. Like, will the RBA lift as aggressively as what the markets are saying and the economists are saying? If they do, we're in trouble. If they don't, we'll have a correction, but it won't be, dastardly. That's sort of my position.
But it sounds like Catherine's got the same position. It's just a question about where it is.
Well,
where's this line? And I guess the thing from Catherine sort of, I think I sort of got 7% from Catherine. I think I squeezed that out of you. Did I?
I thought it was 6, wasn't it?
Was it 6?
Can I just
because under the economist forecast, it's the variable mortgage rate will go above 6, and under the markets it'll go above 7. So I guess my line is probably about 5, really, before you start getting some decent house price falls, and it becomes contractionary, quite contractionary for the economy. But I think at 6 or 7%, you're in real trouble. That's, I guess, my line.
So, Catherine, can I pull a number out of you? Or
I want to say a few things that I kind of to not against what Leith is saying, because he's correct in regard of looking back to the 70s. But I mean, arguably, I would say that we have worker shortages at the moment in a number of sectors. And I have mates that work in the construction industry that have been advertising for labourers and cannot get them no matter where they advertise. And actually, the developer I met yesterday was talking to me about this one issue himself. He's a very big developer, so he was having this problem as well. And then when they do get replies to the ads that they're putting in, people want to negotiate. And if you look back kind of what we've just been through, which was, COVID, what COVID did, shut everybody in their properties. And it made them do things that they would never have done had they not had that dynamic happen to them. And that was a kind of surge of the technological age of innovation, of starting online businesses, at looking at different ways to source and to bring in income. And I can tell you, I don't think there's ever been a time where we've had the potential to bring in multiple sources of income like we have now, whether you're looking at someone that is going out and doing Uber, for example, or doing something on the side, I don't know, DoorDash or whatever, starting something up on an Amazon business. So I think that there are ways that you can bring in income now that you weren't able to, couldn't used to do that.
But that only work. That might work for the individual, but it's not going to work for the economy wide. So you can't have like 5 million people all trying to drive Ubers, and you know what I mean? Like it works as an individual. If you're an individual who's in financial trouble, you can do all that stuff. But if everyone's in financial trouble, because
but you're kind of jumping ahead, because everybody isn't in financial trouble right now. People aren't in financial trouble right now. You've got people well ahead. Let me finish my points. That are well ahead of their mortgage repayments, right? So we're not at the point where we're in financial trouble. You can say, the media is going to town on the clickbait. Let's find a mortgage. Let's find somebody that bought $1 million plus property, young couple, first home buyers, the innocence that the banks dared to lend to, right? Because now you're in this cycle where people are going to start blaming. Let me finish, right? So people are going to start blaming the banks. Yeah. Everything. And they're saying, well, you've got to pay, we're going to have to pay an extra $100 or something a month. What I'm trying to say is right now, what's happening right now is doable. But there's other factors that push into the market as well. And these are things that I see on the ground and that are developing very quickly on the ground. And this is kind of, again, from the technological idea, which we had seeds of those developments prior to COVID. But now everything is transforming very quickly because it supercharged the technological, evolution, and that is things on the blockchain. So it's the ability of people to group together and buy. It's the ability of people to say, the old model of, we'll go in and take on a 30-year mortgage and then pay it down and buy a house. Those things, they still exist, but there's an evolution that's going on in the market. And what I'm trying to say with all these drivers is these are the things that kind of buffer you in this phase where you've got rising rates from the RBA. So you can argue about what was going on in the 1970s, and that's fair enough. But then you can also, look back at this era and say, well, there was stuff that was going on in this era that was pushing it as well. Not to forget when I point out that rents are rising very rapidly. Now, they can't rise on a fixed term contract. So these are things that filter in. Because once you come out of a fixed term contract, and this is very common with the buyers that I work with, they want to ramp up the rents to market rent. And those rents are jumping really quite a lot. So the increased earnings that you've got, these different streams of income that are coming in based on the fact that, okay, you can go out now and get a job, and okay, you can get other streams of income, and okay, if we can't, we need to invest because we need to find some way to buffer against inflation. People are worried about it, so we can group together and buy. And there's all these platforms, newer platforms that are coming on that are allowing, these dynamics to play out into the market. These are the things that I'm talking about, which kind of that you miss if you're just going to say, well, they're hiking up interest rates and at some point it's going to crack.
Yeah. So there's a structural change then. I guess it's an important point. We've also got that point about, the number of people that want, are now working from home 3 days a week or 4 days a week. So an extra room or an extra study or there's some structural change, and still people moving to going through sea changes or tree changes or whatever, and moving to suburbs or moving into rural areas. I mean, that I guess that's been one of my main sort of focuses as well, is this idea that whatever we have, massive amount of vacant dwellings, 10% or 11% vacant dwellings, you don't need much of a move in that to up or down. And so there's been a push over the last couple of years to say, well, most people's lives have changed in some way because of the pandemic. And so there's actually probably a demand for bigger houses or more rooms or whatever it is, or fewer flatmates that's sort of driving that. But I guess there's also this economic argument that at some stage that goes back the other way, in that it doesn't take a very big change once you hit that tipping point of if wages aren't growing but inflation's booming. As you said, we've got inflation booming. We're about to get hit by an energy price shock across the eastern seaboard. Plus, interest rates, that equation starts turning, and you start getting people go, well, I will, yes, I'd love to have an extra study, but I better get a flatmate in because I can't afford the place. And I guess, Catherine, do you sort of see that as do you see that as a problem where you're talking about wages not growing as fast as inflation, or is that overwhelmed by these other forces you're talking about?
I think that, a lot of this is, I think, down to timing, because there is going to be a point, where what we're seeing is going to crack the system. So, the speculation and the way that the policies have gone to push people into housing, my point, I guess, more so is that we're going to get to a point in the timing where the forecasts are going to be right and prices are going to drop. But my push is that the things that are enabling the things to continue. And I think as we get over time, you'll see the economy prove. So as we get through the years and inflation is rising, it could be that other sources of income begin to improve from it. We're looking very much at the moment right now and saying, well, people are looking. So, a home buyer might look at the market now and say, look, I can't afford a lending rate of 5%. What am I going to do? I can't afford it. But over time, it could be likely that they will, because of different sources of income that are going to come in that are going to allow them to be able to do so. So I think that that's kind of my point that I'm making now, is that we're going through to a different age. But the idea of people moving out, I think this is also, nobody foresaw, and I certainly didn't.
No, I didn't.
So, I know the cycle, and I could say, well, okay, there was going to be a downturn here, and I can say, and there's going to be a downturn at this point, and this won't affect house prices, but then this downturn will affect house prices. And that's really, but I never, thought that there was going to be such a turnaround of decentralization of people moving out of the cities, and they're just not valuing city amenities like they once did. But that's significant because of what I said in the terms of the buyers that I deal with. So prior to COVID hitting, I didn't travel out to the regional centres. If people wanted to invest and they wanted the thing that everybody wants in Australia, the capital growth, they wanted land price inflation, then the idea was that you wanted to get, into the metro area. And that's just not the case anymore. People aren't overextending to the point where they're going crazy in the market. We're not seeing people, go along and just bid whatever at auctions. People are being careful with what they do. So right now it's a caution of what is happening right now, but it's not, you can't look at it one-eyed. I think if you look at it one-eyed, you're going to miss the fact that people were saying these same things back in the run-up to the previous peaks of the cycles, which I pointed out, 1973, 1989, 2008. In those peaks where we had rising interest rates along with rising prices, it was always in the media. Always, is this it? Is this the end? Price has gone up. Always, this the same rinse and repeat news stories. Now, how are people going to afford it? And there's always a reason people can't afford it.
Yeah, and I guess what I'm thinking, Catherine, is there's sort of like, in a way, those analogies you're saying are partly the same, but in one important way they're a bit different, which is at the time that was like we have this really strong demand, and the RBA is like pulling on the lever trying to pull back demand and want to slow things down because we just had, and lending was very strong and all that type of stuff like that. At the moment, what they're doing is saying, well, demand's a little bit strong, or a little bit above average, maybe not even, they probably never use the word strong, but supplies are all constrained, and so we need to drag demand to supply level. And so that's sort of one argument, sort of on one side. Let's just put that to the other thing, I guess, is in a way what you're saying is, I guess, is it sort of that, maybe there definitely are a lot of people out there have done very well out of the whole pandemic, and maybe they're the people bidding up houses to these crazy levels and chasing this stuff. But the people who can't afford it, well, apartments aren't that expensive yet. If rates rise, they will get, but relative to history, if I showed those same graphs showing Sydney and Melbourne being at record highs, the Sydney unit market is basically at the 50th percentile on versus wages, and Melbourne is sort of at a similar level versus wages. So maybe it's just that different things in different segments of the market might be going on. I don't know. There's sort of two questions.
Yeah, I mean,
to that.
it's a fair call regarding units because they really did get hammered through 2020, 2021. The apartment sector was really suffered over that time because you saw so many of them come on that were short-term rentals and turned into long-term rentals. And it's like guys in the city were saying that they'd never seen anything like it. Not just in the city. I mean, I've spoken to quite a few agents, even agents in the inner city that were dealing with houses where they just had stock come in. And that goes back to what you were saying about the vacancies, because at Prosper we do the vacancy studies as well. And the point that when I used to write those reports that I'd always put in the report is these are hidden. You don't see them until there's a crisis. And that's when the vacancies appear, because people aren't holding on to them for yield. They're not necessarily interested in, renting them out. And so all of those things, once you get a bit of a crack in the system, are seen. But the interesting thing about apartments, of course, is things are recovering now because we are seeing the big builders go bust. The construction industry get totally hammered. They were hammered in 2018 from the Royal Commission. You could not borrow to develop. And when you were trying to refinance once you'd done that development, the banks were really going hard as well. So there were a lot of developers that really suffered over that period of time. And then, of course, there have been now, because of the rising building materials and fixed term contracts and all the problems that brings in as well. So the construction industry have been hammered, which means that you've got pressure on vacancy rates to go down, and that's going to feed into apartment prices. So you will see apartment prices recover a bit. But because when you've got rising rents, it encourages buyers. When you look back at the old writers of the housing cycle, right? When you look back at Homer Hoyt, wrote his book 100 Years of Land Values in Chicago in the 1930s, and was saying, there's a housing cycle and this is how it runs. His progress of it started with rising rents. And because rising rents trigger a few things off. I mean, I know, first of all, that, the bank will lend you more if you've got a higher rental appraisal on the property that you're looking at. That leads to a little bit of fraud in the system because, as it always does. But so first of all, they increase the amount that the bank's willing to earn, but they also push renters to become buyers, because nobody wants to be in the middle of a rental crisis. And so that will probably feed into the apartment sector as well, because if they can't afford to get a house where they want to live and they want to live in an apartment, then, maybe they'll do that. Now, I've always been, I don't change my view that if you really want to speculate and win the game of speculation and the Ponzi system in Australia, then do not buy apartments. It still maintains, but it will be interesting to see how that plays out.
Well, I guess that the thing for the rents is just on my numbers, the Sydney, I sort of look at the Sydney market and it sort of goes from, let's say on units. So not let's talk units. Sydney market sort of goes from about maybe 80-90% of mortgage payment to rent, sort of was where it seems to bottom out, and then it topped out in 1990 at sort of 170%. And topped out in 2007 at sort of 150%, and we're at 150 now. I guess with the current rate rises that we've seen. And so I guess what I'm looking at is it's already in Sydney. If you're even in the unit market, you're paying 50% more if you want to buy something. So if you're renting for $1,000 a week, it'll cost you $1,500 to have a mortgage. Before any rate rises. Melbourne's 127 at the moment, but it sort of bottoms out closer to 65% and tops out closer to 150. So it's sort of got, I don't know. I guess what I'm saying is it's there's not a lot of room left. Like if you get another 1% rate rise, then I get the argument that people when it costs me $1,000 a week to rent and I can get a mortgage for $1,000 a week, great. I can lock myself in and I don't have to worry about rent rises anymore. But if it's $1,000 a week to rent and $2,000 a week to buy, I sort of figure that's at some point it gets too much.
But it's also
regardless of
it's also about whether or not the banks will actually lend to them as well. Like, because you got serviceability buffers and all that sort of stuff, and then obviously access to credit becomes harder the higher interest rates go as well.
And actually, that's a good point, Leith. Catherine, do you think people have got problems with access to credit at the moment, or is it still pretty free?
Not as much as they had done a few years ago. I mean, they still run all the checks and everything. There's still caution out there, but you can get access to a loan. But I think also the other thing that you tend to see over this period of time is that the banks come out with these fancy mortgage products that But so, for example, now everyone's in offset accounts, which buffer against rising rates. So, you understand the offset account, right? What an offset account is, where your money goes in and it offsets the interest that you're earning on the money. One account is offsetting the interest that you own on your mortgage, and that it's got redraw facilities. So there's a lot of money that is sitting in offset accounts at the moment because people are so far ahead. But also, I mean, it wasn't so long ago. I didn't kind of follow up on the story, but where ANZ was saying that they were reducing. This wasn't after the recent rate rise, but after the first one, that they were reducing the variable rate on their home for new borrowers, for trying to bring new borrowers in. I think you're going to find that the banks are going to want to keep lending. So there's going to be a lot of pressure from brokers to say refinance, get your mortgages refinanced, shop around, find the bank. So there will be some kind of competition within the sector to, kind of go against that. But I mean, I get the points that you're making. Like I said, everyone's cautious to it. The people are worried about it. And it does come back down to what we were saying at the beginning, what Leith said at the beginning, which is how fast is this going to happen and how quickly a rate's going to rise and where they're going to go. But yeah, I mean, the serviceability buffers have been there for a while. I mean, when the last serviceability buffer was put in place, everybody was screaming and saying, oh no, the serviceability buffer, that's it for house prices. They're going to come down because now people can't borrow as much. But they didn't,
Yeah, but that's partly because interest rates fell. I mean, mortgage rates tanked over the pandemic, so even with a 2.5% serviceability buffer, that kept shrinking. But now we've got the opposite impact where you got discount variable mortgage rate of 4.1 or something. If it goes to 6 or 7, is APRA still going to require a 2.5% serviceability buffer? That means they're going to have to do an assessment on 8 to 10% mortgages, which will completely contract credit.
Yeah. At what stage? So I guess there's two sort of things built into this, because in a way, am I right in saying, Catherine, that I guess what you're sort of saying is, look, people are already out there buying and sort of still looking to buy, and so there's enough momentum in the system and the psyche that our tax system's loaded up towards this. We're still letting people bring in as much, there's a few reports out already on the amount of illicit funds ending up in the Australian property market and supply issues, and so there's enough momentum to sort of carry it through for a bit longer. I guess there's two parts to that. One is this idea that, as you said, bank and credit's really important. When we had the Royal Commission and bank and credit all of a sudden froze up, house prices tanked. So in a way, an implicit assumption is that banks won't pull back on their lending. And sort of on the back of the forecast interest rate rises. And I might start with you actually, Leith, on this one, is whether, because do you think banks are going to the credit flow from banks is going to get tighter, or do you think it's going to get looser or about stay the same over the next sort of, call it 12 months of
look,
in terms of actually trying to get credit?
Quick answer, not sure. But even if it stays the same, like their willingness to lend, as interest rates go up, obviously borrowers are assessed on having to repay that rate plus 2.5%. So if it goes to 6%, the discount variable mortgage rate, as the economists say, you're going to be assessed at 8 plus.
Sure. I guess I'm just talking more about the willingness, like in terms of like when we had the Royal Commission, there was obviously a thing to go, look, no, don't lend. And then post the Royal Commission, we had the Treasurer out there whipping, saying banks have got to get out and lend money to people so they can buy houses. And so
I guess it could go either way. I mean, from an individual bank's perspective, they might think, now's probably not a good time to lend because property prices are going to fall, blah, blah, blah. But then if they all think that way, the whole system, you're going to exacerbate the downturn. So
exactly.
It's hard to say because
that's fine. Catherine?
I guess my answer is I don't know.
Yeah, Catherine, what are you thinking? That banks more lending, less lending, about the same in terms of, I guess, willingness to lend as opposed to ability to lend based on interest rates?
Yeah. Well, I mean, the banks want to lend, don't they? I mean, to
well,
me,
yeah, but it does change though. Like obviously in the Royal Commission, they still wanted to lend during the Royal Commission, but they wound back what they wanted to do. And then after the Royal Commission, I'd say they expanded their willingness to lend. So it's sort of like this loan officer surveys type issue.
Yeah, we should get a mortgage, but one of the mortgage brokers I work with on, because obviously they're going to be able to give you a more detailed answer than I'm going to be able to regarding the lending situation. But the people that I'm dealing with are not having problem accessing credit from the bank. Obviously, they're still looking at things closely, but all the same things that have been going on for decades are still going on right now.
But do you see that the banks, I guess, can you see any trends in terms of whether the banks would be, like in terms of it's sort of a macro outlook? The macro outlook going into the Royal Commission was banks are going to wind back on their lending. The macro outlook coming out of the Royal Commission was banks are going to expand who they're going to lend to. Is there any sort of thing with that, or is it still just there's no real trends from your perspective on that front?
Yeah, I mean, my opinion, just looking at the cycles, is that banks are going to increase the credit that they're lending it, that it's going to keep pumping along. I mean, that's my forecast. Do I have any particular evidence of that? Not really, but the Royal Commission was a very particular time.
Oh, look, yeah, absolutely.
I mean,
absolutely.
they were under a magnifying glass. The Royal Commission was going on. I mean, it was what
but there
happened.
Is also an element though of new government. Sorry, Catherine. There's just an element also of new government. Obviously, the last government was out there, telling the banks you got to get out there and lend. I don't know whether the new government is going to do that or not. Or
I think we all know here that whether you've got Labour or Liberal in, and actually CoreLogic came out with some graph that showed this just before the election. It doesn't matter who's in power, booms and the go regardless. It doesn't matter who's in power. If a home buyer grant needs to be pushed in, they're going to push a home buyer grant in. And you've seen those stimulus happen, whether we're under Labour or whether we're under Liberal. It doesn't matter whether you dress it up as a shared equity scheme or whether you allow buyers to tap into their super. And they know themselves. And I know this from the work that I do at Prosper. We deal with politicians all the time. We deal with Treasury departments. The consensus of I was discussing this at a meeting that we had last night. The problem isn't that they do not understand. They do understand where the housing bubble comes from. They understand what speculation does in terms of the housing cycle. Everybody understands that. The problem is in transition. They don't know how to transition out of the system. And so I don't think that what we're seeing now, so say with the Labour shared equity scheme that they've got going on, right? So that's their program, and I think it's got 10,000 places or something. They'll expand that. If that gets taken up, they'll expand it. Then you've got the individual states and territories and what they actually do to encourage buyers to get into the system, and the stamp duty cuts and everything else that goes in. So to me right now, there's fuel that can be thrown at this, and I don't see from the working with the mortgage brokers that I work with that there's any problem at the moment with accessing credit, or there's any problem with the banks giving credit. It's not like I'm purchasing places and the banks are going through and valuations are failing. Let's put it like that.
No, good. Okay, so another, just wary of time as well.
By the way, that was happening at that point. So
yeah. In terms of this momentum idea as well, that there's enough momentum in the market to carry it through. At what point do you think the people, I guess your psychological assessment of where do people that you deal with, where are they going to get worried? So it's I guess what I'm thinking is, if they're sort of going, oh look, markets have fallen 2% or something like that, they're like, no, that's fine. There's enough momentum still. I'm still out there buying. And maybe at 5% or 10%, they're still like, oh, great chance to pick up prices at a cheap rate, or is it, or is it, at 7 to 10%, people start to go, oh, just a minute, why have house prices fallen so far? Maybe I'm wrong. Let me step back and wait and see see where it bottoms out. I guess where's your thought about what point does the market that psychology towards house prices always go up? Yes, but in the pandemic, obviously we had some big falls in house prices, and everyone sort of just took a step back and said, well, I'll wait and see how things come out. At what point do you sort of see, Catherine, that how far would house prices have to fall before you'd go, look, people will start even if they're bullish to the house market, they'll just go, well, I'm not quite sure what's going on. Let me just stand back and wait to see what happens with prices.
Yeah, well, first of all, the one thing that's going to cause a crash is when you get mass sales, isn't it? I mean, foreclosures go onto the market.
Yep.
So you have to be in a position where people who already own property, who got into the market over recent years, cannot afford the mortgage rates that are coming in, and that you're starting to get increasing number of foreclosures that cannot be covered. And so you get this massive foreclosure that hits the market. That's what happens at the end of a property cycle. Right? That's not where we are now, because we all agreed that people are ahead in their repayments, and right now we're not at a point where that's going to crack it. Now you're saying to me, how high do they? You've asked me like different ways.
No. I'm asking a different question here. I'm asking, like, let's say tomorrow the house price fell, the housing market fell 20% for whatever reason. Something happened, and all of a sudden the house price market just fell 20%. My take would be that, there'd be a lot of prospective buyers who would turn around and go, 20% fall in house prices. What happened? I'm not buying. I'm not chasing this. I'm going to wait and find out what problem comes out. And I guess that's what I'm asking you is at what level. So I guess what I'm asking you is you've got this view. Let's say macroeconomics don't really change. Interest rates just gradually tick up over the next little while, but house prices fall 10%. Is that enough to scare potential buyers away and turn 10% into 20%?
Yeah. Well, you only need to look back at
or will they pile in?
Back historically at what's happened over recent years. I mean, in 2018, we had a really big fall in prices in 2018. It didn't crash the market because people were still honouring their mortgage payments, but there was no one out there that wanted to buy. And I was in 2018, working, obviously running a buyer advocacy agency, saying to people, it's a really good time to buy because the bargaining atmosphere is so good, and no one wanted to step in. First home buyers, they weren't step. First home buyers were like, this is it. This is what we've been waiting for the last couple of decades. We're going to wait and see how far this goes. And and nobody wanted to buy. That's why I say, when I'm dealing with Prosper and we're trying to work out, because a lot of this about changing the system is about changing psychology, right? People need to see a different way. They need to see the path ahead in order for the system to change. But I would say nobody really wants affordable housing in a market like we have now, because no one wants to buy a property and the price to go backwards. And the only way that you're going to get affordable property is for land prices to go backwards. So first of all, there's a point there where people freeze and panic. Now that happened again for a short period of time in that March, in the initial fall, the initial downturn in 2020. Everything was going gangbusters. So as soon as the market switched after the election and the Royal Commission was over, and it was like darkness to light, right? This kind of immediate change in the atmosphere of the market. And then everybody wanted to get in. All the first home buyers that hadn't purchased were all coming in then. I'd never had worked with so many first home buyers that were saying, oh no, we really wish we'd have bought then. And we feel like we've missed the boat. And actually that's kind of the still in that atmosphere now a little bit from buyers that I deal with now. So there's no real nervousness out there in terms of buyers aren't coming to me and saying, we actually think the market's going to crash. A few people are. So like I talked to a few people that say to me, we're a bit worried about it, or because they're reading something that's in the media, but it's not like that sudden shock pill that you got in 2020. If you go back into because I was working, obviously, again, I still work in 2007 in the lead up to 2008, which was that was timed with the cycle that we were going to have a crash at that point. But that was when you were getting quite rapid rate rises through 2006, 2007. And I remember it got to the end of 2007 and I was bidding for someone at an auction. And one of the other buyer advocates that I was there with, who's been in the industry for a long time, a chap I used to work with, and he said to me, Catherine, get ready for a passing, because I reckon that last rate rise did it. And at that point, lending rates were around 9-10%. He was wise. He'd worked in the real estate market for a long time. He just knew it. He knew that there was a change. Now, we hadn't seen a passing for that year. It had been one of those years where things were just going gangbusters and everyone was in shock and horror. And the property passed in. It took us a 45-minute negotiation once it passed in to negotiate it. But that was when the market cracks. Usually nobody's expecting it. When you get to that point where you think there's going to be a downturn, it's not because people are saying, oh, no, we're just not going to buy, because now we think that the market's going to crash. The point where the market crashes and there's downturn is when things are looking great and everybody's out there spending. And at that point in 2007, I tell you what, people there was all these things that, you could borrow 105% from the banks. People were doing it. You could borrow this kitty financing, right? You borrow your deposit and you borrow your mortgage. So, I mean, people were out on all these schemes. They were down the back of the sofa, pulling out everything they got to get into the housing market. Nothing looked like it was going to go wrong. Then along the crash came. So, that to me is more of an indication of what we've got now, where people say, no, I'm a little bit cautious. I don't think I'm going to borrow as much.
Yeah. Do you think so we've floated this idea of land taxes, and New South Wales government sort of has talked a little bit about it. Have you got any thoughts on that front? Would that be enough to slide some markets back on? And do you think anywhere's, or in particular, I guess New South Wales, which has spoken a little bit about it, is anywhere actually close to putting land taxes on?
It depends on what the switch is for land tax. So, I mean, if they strip away stamp duty and put it into a land tax that doesn't completely offset that, then you're not going to see prices fall initially. You're going to see prices go up. If anything, it's going to increase the turnover of property, because there's not going to be any stop on. You're not going to need to have as much money when you go in to buy a property. So, if anything, the things that we talk about at Prosper. So obviously, right, what we're trying to do is completely change the tax system. What our ideal is, we know that it's we're not going to win if we go in saying this immediately, but is to take taxes off income and productivity, labour and productivity, and put them into monopoly rents, of which residential land is a big one. But if you were to do that as an immediate switch, right, people are going to have a lot more money. It's the first thing that you would find is an inflation in land prices, not necessarily falling back of land prices. Eventually, once the transition has gone through and you're going to get less speculation in the land market, then you're going to get the outcome, perhaps that you want, a lot more affordable accommodation than you're getting now. But the point about, the tax system is, again, it's this what is offsetting driving it, because it's the speculation in the economy. I mean, if you're an asset owner right now, I mean, anybody that's running a business and paying, their PAYG and everything, your taxes are really high. I mean, everybody is trying to offset their income tax into the ones that are the winners are the landowners and the
Yeah, sure. But I guess what I'm saying, sorry, I guess I'm asking more, do you think New South Wales is actually like anywhere close to it, or is it all still, I guess, talk?
Yeah, no, I think they are. I think we've never really been closer to it, because a lot of so there's been a few changes recently. I mean, Queensland have so there's a lot more awareness of this within state and territory government. Obviously, Canberra were very successful with the switch that they did. Easier for them because they're just one council, and it's leasehold land anyway. It's an easier kind of switch for them to do. But everyone's been talking about it sort of since we got into 2020, and then Queensland recently came out and said, well, we're going to take away the threshold for people that own, if you own property in Queensland and you also own property out of state, then we're going to take the whole value of all your portfolio into account when we put you in the tax bracket for your property in Queensland. So that, because there's always been a trend for people to avoid land taxation by staying under the threshold and investing in different states. Those ideas. I mean, I talked to I talked to a lot of people in Treasury. I mean, even in WA. I mean, these are low hanging fruit really to do that kind of switch. So I think there's a lot more energy for it than there used to be, and there's an easier ability to sell those properties sell those policies than there perhaps once was. So I think that there's an absolute chance that we could see that happen. I mean, what do you think, Leith? You follow it?
Yeah, well, on the whole land tax thing.
Yeah, what do you think that there's, that they're kind of pushing towards a transition?
Yeah.
I should have actually, before you go, Leith, I just want to preface this. Sorry, I probably didn't lead into you enough, Catherine, in this for people who haven't listened before. Catherine is the head of Prosper, which is an organisation looking to try and move away from stamp duty to land taxes because they're so much more economically efficient. Sorry, let me just preface this by that.
It's one of the things. It's not. We're not kind of so it's Prosper Australia Economic. It's Australia's oldest economics organisation, and we want to see complete tax reform. Just like I said, we want to see taxes come off productivity in labour and put onto monopoly rent. So we want to switch it so that we're encouraging people to work and innovate and everything, and we're not out there encouraging them to speculate, for the money to go into land. But because we can't do that big switch and we're not going to get government to listen to us, we do a lot of work on the edges as well. And one of the policies that we've pushed is, yes, a switch from stamp duty to land taxation, and we've seen some energy towards that. The speculative vacancies reports that we did, had some push in getting the vacancy tax put in. That wasn't what we recommended as policies, but it does take note. And of course, there was the windfall gains tax that came in Victoria, whereas you sit on land and you're waiting for a windfall, and to discourage that activity. So that those are the types of things we kind of work on the edges of those, trying to get policy to steer policy in the right direction, even if we can't get the outcome ideal outcome.
Yeah, excellent. Yeah, so excellent. So for listeners who might be a little bit confused, sorry, we probably didn't explain that well enough. We're basically hitting Catherine on two fronts. One is as a property advocate, what she's seeing on the ground and all that type of stuff, and then this is sort of like I've segued into something completely different without probably explaining it well enough. Now, Leith,
yes.
over to you. What are your thoughts in terms of property
shifting
tax?
from stamp duties?
Any actual movement?
Shifting from stamp duties and land taxes, absolute no-brainer, economically, whatever. New South Wales government last year announced that they were going to look to do that, although there's been a lot of backsliding on that commitment. There's basically, once Dominic Perrottet became the premier, there's been almost zero movement on it. They released the proposals, and since that, then all the discussion out of the Treasury, etc., has been basically backing away from that commitment. So I don't think we're actually going to get it in New South Wales. And in Victoria, idiotic Victorian government has actually done the opposite, and they've actually gone harder on stamp duties, actually increased stamp duties for properties over $2 million, which increases the budget's reliance on stamp duty. So they've gone the other way.
But Victoria's also put on that windfall.
Oh yes, no, which is good policy. Yeah,
good
of course.
policy. Do you think, is there any other places, and maybe this question for you is Catherine, any other states that are looking at what Victoria's done on the windfall side and thinking to follow?
Is this to me?
Oh, to either. Both. Yeah.
Me?
Maybe you first.
I think South Australia was looking at it, but I need to double check that. Windfall gains tax. But yeah, on the stamp duty land tax, really only the ACT has moved, and it's like a transition over 40 years or something, 20 years. Yeah, New South Wales said they would do it, but they're backsliding. So I believe it when I see it. Really, the federal government needs to incentivise the states financially to and help the transition if they want. So like all tax reform, the federal government, because they collect 80% of taxes, state and local governments collect 20%. The federal government needs to basically pay the states for any reform that's going to boost productivity, because the gains from that go back to the federal government. So this whole process needs to be led by the federal government.
Yeah, and that was Catherine. We were pitching at. I'm not sure if you were on that episode. We were certainly pitching from a stimulus package in the pandemic. Was that it's a perfect time to basically go, nobody wanted to buy houses at the time. It's like, get rid of stamp duties, put on land taxes, funded by the federal government over that period of time to, as a stimulus. But anyway, lost opportunity. Yeah,
mate, how many have there been?
But so Catherine, are you seeing any places you think might follow the Victorian windfall tax?
Yeah, well, I'm actually, Leith knows probably more than me. I'd need to go and have a look, but not at the moment. Not that I know of at the moment. There's always conversations. I think that's as much as I'd say, and we're always pushing for it, and there's always reports going to government and suggestions for it, but it's just whether they feel that it's politically palatable for them to do it, because obviously their first priority is getting re-elected, so they don't want to do anything that's going to interfere with that outcome.
Yeah, absolutely. Hey, okay, so sorry, I should wind up, because I know we've kept you for a long time. Can I just sort of summarize the overall view, because I just want to check this is what I'm hearing from both of you, and maybe then give you a chance to refute what my summary is or agree. So I guess what I'm saying is, Leith's view is, look, rising interest rates, 3% baked in, takes us to 7% mortgage rates. The Australian consumer can't handle it. They're already starting to become stressed, and as the rates rise, as we see successive rate rises, that's going to crash the housing market. And they're probably going to have to stop earlier because the Australian economy just can't handle that higher interest rates. Catherine, I guess your view is similar, but what you're saying is the market's still got lots of momentum, and it's still got another year or two to run before, or have you got a time frame in terms of a couple of years to run before you reach that point of rates are too high and that's enough to roll the market over? Maybe start with you, Leith. Have I got you right?
Yeah, pretty much. The whole argument depends on how aggressively the RBA raises rates. If it raises, as the economists or markets are predicting, we're in trouble. I don't think they'll go that hard, so we're not going to see as big a falls as what you would get if they did that. Yep. That's my view. Yep.
And Catherine, how many years to run, do you think? Am I right in paraphrasing what I think you've said? And how many years do you think it has to run?
What I'm saying is eventually they will, but not right now. And we do have a few more years to run according to the cycle. So we're looking at around a 2026 peak in the property market before you see a property crash into 2028. And that cycle has a lot of history, a lot of good theory behind it. If you want to read more about it, then you can go. I write for Factel Investment Research, a publication called Cycles, Trends and Forecasts, where I go into the history and why I'm so confident that that's going to play out. And that's really what it is, because if I was just looking, reading the newspapers and blowing with the wind like a lot of the economists do out there, then you're going to cut. That's what I was trying to say about the CBA forecasts and the big bank forecast economists that come out. They're reading the economy like they're looking at the weather. They're saying, well, look what's going on today, and then we'll just work out what's going to go on ahead. And then if that works out wrong, then we'll change the forecast. Nobody studies cycles, and it's really important to understand why cycles occur, why there is a land cycle, why the land cycle repeats, why it has done for centuries. And once you understand that history and that background of history, then you will see the pattern that will give you the confidence and the understanding of where I'm coming from, where I'm saying, yes, it doesn't look great when you're on the ground. It didn't look great when you were on the ground in 2020, but I'd still said there was going to be the greatest property boom of all time that was going to occur around that period and going on into 2026, which was what happened. I said that we weren't going to get, 30% falls in the property market. It's based on knowledge and understanding of that cycle. So that's really where I come from. And obviously working on the ground, I'm seeing that you cannot look at this one-eyed, that there's a lot of trends out there and there's still a lot of confidence in the property market. Buyers aren't running scared. The mortgage brokers are busy. We're not at that point yet. That point will come. That's not me supporting the system and saying I'm being a real estate spruiker and saying it's always a good time to buy. There'll be a time where it won't be a good time to buy, but that's not now.
Excellent. And just a quick as well, I'm stealing Sam's wrapping up as well, but Prosper. So if anyone's interested in Prosper and helping with tax reform, where can they get in contact with you?
Google Prosper Australia, prosper.org.au, and have a look at some of the work that we do. So we conduct a vast amount of research into land, into property, into the economics of land. Now, all of that research that we do will give you a deeper understanding again of the land cycle and the property cycle, which I talk about at Factel Investment Research. Again, if you Google that, you'll find me on there. But support the stuff that we do. Because if you're passionate about changing the system and having a better Australia than we live in now, then the answers are within the work that we do at Prosper Australia.
Excellent.
Nice one. Thanks for that, Catherine. So we've had lots of questions come through. Most of them have been answered during the conversation. Jerry in particular was asking about what point interest rates are going to be too high for the economy, and everyone seemed to dance around that one without sort of giving
we get to the peak of the cycle is so. Just to give you some context just around that, because it's an important question, is every point where you reach those peaks in the cycle, there's a rapid rise in rates, and that's the point where it's going to be, where when you get into around 2025, 2026 is where you want to be really cautious, because that's where you're going to experience a downturn into 2028 after that. So there is a point where I would say, not necessarily other people, but I would say that we're heading towards.
Yeah, that's interesting, because we've had a comment from David Mackay in Sydney, saying that Sydney normally leads the cycle. Right now, he's seen a major shift in the momentum. He was saying that FOMO is almost completely finished, and FONGO is the new talk about town. I'm guessing that's fear of not getting out.
So Sydney does peak early in the cycle, or at least it hasn't always, but it certainly.
It's always Melbourne and Sydney, yeah.
And that makes sense from, it's just like a bigger suburbia, the more expensive suburbs peak out, and then people, move on to another suburb, and you get a burst of short-term growth, and then that peaks out. But because Sydney, what happened in the last cycle was it peaked in 2004 and then stagnated into 2008 before we had what should have been a property crash at that point. In fact, it very nearly was. But but I mean, that was also following the Olympics. There'd been a lot of speculation in the lead up to the Sydney Olympics. So it would be expected that you would see that in Sydney, and then you'd see speculation. And that's kind of my point as to why we're seeing a lot of speculation going into the smaller capitals now, Adelaide and Perth. The smaller capitals and territories by population always do better in the second half of the cycle. So when I'm talking about that there's a cycle, there's a first half and there's a second half. We're in the second half now, and they generally do better in the second half.
Yeah, and also we've had comment from David Mansueto saying that there's sort of an emergence, seems like there's an emergence of a two-speed or split economy, with lots of sort of different gaps and widening between suburbs, cities, income growth between different jobs and sectors. So that's a point you guys touched on briefly. Also, a comment came up about immigration. The Big Australia policy, that tap's been turned back on. So that can have an impact.
It hasn't. They want it to be turned on, but the flows aren't
tap's
coming.
Been turned on.
Yeah,
that's right. I don't know whether your thoughts, Catherine, whether that's going to be a major issue for you if we don't get a flood of immigrants.
Yeah,
we'll tighten the
30 second.
You can't rank it up to where it was overnight. It's not like you just say, okay, the doors are open, everyone's going to rush back in because of things have happened. It's not quite the same. But yeah, it does affect Melbourne for sure, because Melbourne's always run off population. Look, in Australia, you need population growth into areas where the supply is restricted for there to be the start of all those things that push prices up, so then the land's starting to be increasingly subdivided because, the population's moving in, and that pushes the development cycle, and then the council have pushed to build more infrastructure and everything. And Melbourne's kind of run on that, this kind of population Ponzi.
We're Ponzi economy.
Yeah. So, I mean, it's significant for Melbourne. And actually, when I say I forecast back in 2019 that Melbourne and Sydney would slow, this was actually with the help of Philip Seuss, and some charting that he was doing, which showed that and had a good history and good correlation. I couldn't work it out at the time, but it was good enough to put out in the publication that I write. So I did put it out there, and because that's been remarkably accurate. Those charts have been, but I couldn't see why it was going to be at the time. But it can only happen in Melbourne where you get the population going out. So if you look back at the 1990s, for example, where Melbourne was, where we did the crash that we did have to have, and Melbourne was really hammered worse than a lot of other states, and our median price basically, we crashed. There were individual. It was a commercial property crash more so than a residential, but there were residential properties that halved in value over that period of time if you go back and you research it. But we didn't go anywhere till around 1997, and that was, we lost population over that period. It was the same. People just left Melbourne, and that has obviously impacted Melbourne from the 2 years of lockdown. Tens of thousands of people have left, so that has to turn around. And it's going to be harder now for Melbourne because everybody's competing for the same thing. Everyone's competing for immigrants to go in. So, Leith, you and I had a telephone conversation not so long ago about what Western Australia is doing to get them back in.
Yeah, absolutely. Well, and not just Western Australia. Western Australia is going big, but we've got Canada, UK, other places. Canada in particular, Australia's competing with these places for migrants now as well. So Canada wants to bring 400 to 500,000 a year. They're giving away permanent residency like Tic Tacs, etc. So basically, you got all the international students from the subcontinent, etc., wanting to go to Canada instead of Australia. So Australia is going to have a lot more trouble trying to reboot the Ponzi this time around because it's facing so much more competition.
Excellent. Anyway, well, that's probably a story for another day.
Yeah, so mate, we'll do a whole podcast on that.
Yeah.
So now we've got our viewer question of the week. So this is for viewers to have some discussion in the comments section over the coming days. So the question is, will Australian house prices crash? So feel free to post your thoughts, engage with us and some of the other viewers over the coming days. So that now almost wraps us up. So, Catherine, just want to thank you very much for coming on the show again. It's a pleasure to have you here and great to have a different opinion because, two different views always create a market. So thanks for your time and thanks for your insights.
No, thanks very much for having me. Enjoyed it.
Excellent. And thanks, Leith. Thanks again. Always value the unconventional economist perspective.
Yeah, thanks, mate. I'm the conventional economist, I guess, on this issue.
Yeah. And Damo, as always, thanks for sharing your views. It's always insightful.
Thanks, Sam.
Okay, so we do welcome your feedback on this podcast, especially in regards to suggestions for future topics. So if you do have any ideas, please drop it in the comment section below or send us an email at contact@nucleuswealth.com. And just a reminder, don't forget to like the video now. And finally, if you know of anyone that might get some value out of today's episode, we'd really appreciate it if you can please share it with them. And also, if you'd like to see more of our previous episodes and content, head over to nucleuswealth.com/content. And to stay up to date with news from us, you can see us on all major social media. So from myself, Damien, Leith, Catherine, and the rest of the team at Nucleus Wealth, thanks for watching, and we look forward to seeing you next time. Bye for now.